to Nirmal Bang, ladies and gentlemen. I'm Hiral Datia. We have with us Mr. Saugata Bhattacharya, Chief Economist at Axis Bank, joining in. Welcome to the show, Saugata, and a pleasure to speak to you as well.
Always.
Absolutely. Saugata, my first question coming to you is, overall, if you see in terms of the inflation numbers that have come in terms of India as well, a 7.04 in the month of May. And similarly, in terms of if you see the IIP data as well, what sense do you make of that number? Because across in terms of economies, we are seeing inflation as a major concern. And you have the central bankers as well who are looking at squeezing liquidity overall and increasing rates.
So thank you once again, Hiral, for this opportunity. Always. So obviously, as you mentioned, I mean, the priority number one for all central bankers, whether it be the Fed, even now the ECB, the Bank of England, and certainly for the Reserve Bank of India now, inflation has emerged as the premier concern, the macroeconomic risk in the system, as they like to call it, price stability issues. On top of that, there are the other factors: growth, the currency, all the other macroeconomic variables. But those are secondary to inflation now. I don't think our situation is as bad as in the US, where the Fed, the US Federal Reserve, might actually have to force a recession into 2023 to be able to tame inflation. So our situation is not that bad, but I mean, we certainly will probably need to take a cutback on growth. So as of now, our growth forecast, as you mentioned, the IIP, the initial indicators now into the month of June indicates that economic activity still remains very strong, despite all the volatility in the financial market, despite all the input costs having risen, etc. So what we are seeing in e-way bill terms, electricity consumption, etc., still strong. So given that, I think, and particularly as you mentioned, the last May inflation print was 7%. We expect that going forward into the next couple of months, it will again be close to 7%. So only in Q4 will we begin to see a significant drop in inflation beneath the 5.5% to 6% mark. So my guess is the RBI will need to tighten, even at the cost of some slowdown in growth.
Right. So overall, taking that number into consideration, where do you see FY23 inflation averaging out?
So right now we are at 6.7%, which is very close to the RBI estimate as well. So but these are based on a series of assumptions. The first one, of course, is crude. Crude at about $100 to $105 per barrel. But in India's case, it's not just the crude price which is important, but it's also the pump prices of petrol, diesel, the other regulated fuels. Because we do not know how much the higher crude prices are likely to translate into pump prices, which is what determines the CPI inflation in India. Beyond that, of course, is the progress of the rains. Even now, it's a little bit deficient in terms of the normal levels. So that is a risk. Besides which, there are other risks on growth, particularly the kind of slowdown that we are expecting in global growth. Remember that the Federal Reserve at the last FOMC predicted the US growth at 1.7%, both for this year and for the next year. That's a significant slowdown in growth. Earlier, WTO, UNCTAD, etc., IMF had predicted a slowdown in global trade, and exports have been a major engine of India's growth story in FY22. So given all of this, there are significant downside risks to our forecast, GDP growth forecast of 7.1%. So that has downside risk, inflation at 6.7%.
Right. And with this number into consideration, if you're saying we'll have to take some bit of a cut in terms of the growth numbers as well, what does FY23 growth forecast at the current stature stand at for you?
So as I said, as of now, we are still retaining our growth forecast at 7.1%. Remember that we had started before the war around about February with about an 8.4% forecast for growth. That periodically has been cut all the way to 7.1%. Remember that RBI's growth forecast was 7.2% with balanced risks. Now ours is 7.1% with downside risk, because I'm quite sure, because the idea of monetary policy tightening is to be able to squeeze growth out of the system. Remember that when we talk about inflation, it's not just the headline inflation, which is being driven by multiple factors, fuel, etc., as of now. But for the last almost 2.5 years, core inflation, which is the non-food, non-fuel component, has been above 5%, most of the time at above 5.5%, now currently at 6%. So, I mean, this kind of prolonged persistence of high core inflation definitely indicates that there is a degree of aggregate demand in the system. It's not just the supply shocks that is contributing to inflation. There is also the ability of consumption to be able to absorb some part of the higher supply shocks. So there is both a supply shock as well as an aggregate demand, and that is what monetary policy probably is aiming to moderate.
Right. So taking this into consideration, as we just mentioned about, oil commodity prices that have been triggered by the war in Ukraine, how big a pressure will that have, according to you, on the current account deficit? Because clearly the trade deficit has widened to record levels in April and May this fiscal.
So we are working with a current account deficit of about minus 3.4%. It was about minus 1.6% last year. So our forecast is minus 3.4%. But that again has upside risks, because as you know, as you just mentioned, that the net imports that we are seeing has pushed up the monthly trade deficit, the merchandise trade deficit, again high. On top of that, the other worrying part is the services surplus that we are seeing. So there's a significant uptick in the net services exports that we have. That is to say, I mean, the amount that we spend outside. I'm sorry, I should call it imports. So the amount that we spend on travel, tourism, other education, other services that we send money outside, that has also increased significantly. So while our IT services and the other services exports have increased, so have our services imports. So given this, the higher merchandise imports and the higher services imports that we are seeing, there is a clear upside risk to the minus 3.4%. What is a mitigating factor in all of this is during times of high crude prices, typically remittances from abroad are relatively high. They increase. So that might be one of the cushions that we can expect for the current account deficit. But otherwise, the other components of the current account deficit are relatively.
Right. So with all of this said and done, do you think, if the deficit is expected to actually increase, the financing is something which could be worrisome of the net inflows of FDI, as well as the portfolio investments are not at expected levels? However, India does have ample forex reserves. So if you have to lay the land on that terms, how big a risk are we seeing?
So you're absolutely right. We talked about the current account deficit. Normally, in normal years, capital account inflows typically keep our balance of payments in surplus. Last year was an extraordinary surplus. FY20 was even higher. Last year was about the total BOP surplus was about $65 billion. This year, we are expecting a net BOP deficit of anywhere between 20 to 30 billion dollars. Exactly as you said, I don't think, given the pace of the Fed, expected pace of the Fed increase, we are likely to get too much by way of additional portfolio flows. Till now, we have seen a fairly large outflow of portfolio. We are not going to get a fairly large. It depends now on what kind of FDI flows. But even there, I think the risk sentiments in global market, till a risk on sentiment begins to develop, once we get a signal that the big global central banks, G10 central banks, are more or less done with the rapid pace of increases, we are not likely to see too much risk capital in any form coming back into India. So given that, I think we are seeing a BOP deficit, as you mentioned, 600, just below that now, $600 billion reserve. So we are okay for this year. I mean, there's no problem for the RBI to cushion a little bit of the reserves. But probably if this carries on for a while, the high oil prices, commodities prices, etc., then next year, FY24, there might be some problem for the RBI, because the buffer that they have will keep on reducing.
Right. And overall, if you see on the fiscal deficit front, how are you viewing it? Because clearly We saw a number of around 6.7% in FY22, and that's mainly on the back of the higher tax mop-up that we've seen. How are you viewing that number, and what's your estimation looking like for 23?
As opposed to the center's budget estimate of 6.4% deficit, fiscal deficit, there is a likelihood of a small slip from there. Some small slippages, say about 6.5 or 6.6. I don't think they will take it too much more. There is one part, as you saw, I mean, in the Q1 tax mop-ups, that direct taxes in particular are likely to remain much above the estimated 13.4% growth, nominal growth in direct taxes that's been estimated. The second part, and indirect taxes to GST collections, while not too much beyond what has been estimated, it's still, because of the high commodity prices, oil prices, etc. Even import, the integrated GST will contribute a little bit beyond the budget estimate. And on top of that, the nominal growth that's been assumed in the budget was only 11.2%. We are likely to see about a 16% nominal growth in GDP this year. So given the two factors, so that increases the denominator and that keeps the percentage of the fiscal deficit in check. Given that, I do not expect a very major slippage in the fiscal deficit, and certainly I think there will be no increase in the borrowing program of the center. The states is another.
Right. So in view of all of this, if you have to look at the RBI as well, we've already seen 2 rate hikes, Saugata, that have come in. How many more are you penciling in calendar year 23?
So as of now, we are expecting at the end of FY23, the repo rate at 5.75. But here again, I think there is an upside. There is a potential upside that might go to 6. And if inflation doesn't come down significantly from our expected trajectory, which is the 6.7% average that we were talking about, it's likely that it might go more. Certainly in the next policy, in the August MPC policy, they will take the rates up from the repo rate up from the current 4.9% to about 5.15, 5.25, which is the pre-pandemic level. I expect them beyond that as well to carry on with their rate increases, much smaller amounts, 25 thereabouts. So that's the reason that I was talking about 5.75. So in October and December policy. But beyond that, unless inflation begins to moderate, we might see one or a couple more hikes as well in terms of the repo rate. They won't be able to do this very fast because given the fact that a lot of our loans now are linked to the repo rate, the external benchmark linked loans. The EMI liabilities for borrowers, MSMEs, home loan borrowers, is likely to begin to increase very fast. So the ability of the borrowers, particularly at the margins, I mean, the weaker borrowers, that will create issues on bank NPAs, etc. So I mean, I don't think they will take it certainly nowhere close to the Fed rate increase. But even our increase will be moderated by the expectations of very rapid transmission this time into lending rates.
Right. So overall, this was something that the bond deals were already signaling in terms of, aggressive rate hikes that could be in the offing by the RBI. Where are you seeing the benchmark 10-year bond deals from here on?
That I'm going to be a little cagey about because I mean it's enough to be able to talk about the basic macroeconomic fundamentals rather than venturing into markets domains. So our average yield that is over the period was about 7.5%. You've already seen a retracement of the yields. Even more importantly, more than the 10-year benchmark, the swap curves. The overnight index swap curves that you've seen, they have come up very sharply and this is tied with the fears of a global slowdown, recession, etc. That central banks will not be able to carry out the pace of rate increases that they are signaling now. So given this, we are still looking at an average of 7.5% at the 10-year benchmark yield. But my sense is that given what we expect of no additional borrowings from the center, etc. So given all of this and given the fact that the repo rate hikes, the pace is likely to slow, the average might end up lower than the 7.5%, which we are working with right now.
Right. And overall, talking from a larger perspective, Saugata, we've heard a lot of comments that have come in terms of, the economic advisor coming in and saying that taking the global economic difficulty situation into consideration, it's not going to be very difficult for India to allow the foreign reserves to burn to shield the system. Do you think that's a route that India can take, and it's going to be a viable route if we have to?
No, I think definitely there needs to be some mechanism for shielding us from the external shocks. Remember again that this is what economists call the impossible trinity, of open economy, macroeconomics. The RBI faces a classic example now. So on the one hand, through via portfolio flows, the capital account is more or less open. The exchange rate remains relatively flexible, and the RBI needs to be able to control domestic interest rates to control inflation. So given this, one of these three has to give. So either you impose capital controls, which is not an option. You need to have control on domestic rates because inflation dynamics are very, very different in the US, in the UK, in the ECB, and in India. So RBI needs control on the domestic rate. So the only variable amongst these that can potentially be controlled is the currency. And as we talked about, RBI has sufficient reserves as of now at this point in time. So my sense is that allowing the rupee to depreciation begets more depreciation. So you need to be careful about that. And of course, the depreciation comes in the form of higher imported inflation, which adds to the inflationary pressures in the system, which the domestic interest rate is trying to control. So given this, I think it is very, very likely that the RBI will indeed try to control the movement of the rupee. Obviously, you need to be in line with most of the good our peer EM basket, EM countries and currencies. You cannot try to fight the overall system, but any deviations within the median EM basket movement of the currency, that I think definitely.
Right. And very lastly, Saugata, in terms of Prime Minister Modi's vision of making India a $5 trillion economy by 24-25, how achievable do you think is that going to be? Do you think that's something which we could stumble upon, taking the growth aspects as well as the macroeconomics into consideration?
I think 5 trillion by 2024-25 is a stretch. There's no doubt about that. But these things are aspirational. It doesn't matter whether you actually hit it or not. It matters whether you're actively trying and setting your policies, structures, institutions, etc. in place. That even if you miss the target by a couple of years, that doesn't matter. But all of these economic mechanisms, which are meant to support high sustained growth, that's what is the important part, because that's what will take India on a high growth path over the next decade. So that's important. So the aspiration of hitting a $5 trillion economy and all the processes, institutions that need to be put in place to support that high growth without and still keeping inflation stable. Maybe we will not come to that 4%, maybe we'll hit at the 5%, but inflation needs to be, we cannot have an 8% inflation, which accompanies a 6, 7, 8% growth. So those are the mechanisms that need to be put in place to enable, if not over the next 2 or 3 years, enable a 8% growth, solid growth over the next decade. That's what is the key important part in setting economic policy.
Right. And very lastly, Saugata, in terms of, apart from what we've already spoken about, any key risks that we should be looking out for from an FY23 perspective?
No, I think, Hiral, you're absolutely right. So the key risk to my mind right now, everything now depends on this, is crude, or crude oil. So that's one part which is definitely very, very important. And then there are other factors like, a very major global slowdown. So it's not just a slowdown, a recession quickly moving in, because that hurts our export prospects. That has multiple implications on with India's the links that we have, commodity links, trade links, financial channel links with the rest of the world. That I think is another huge risk. Besides which, the evolving geopolitical situation. Who knows? Which part of the world might blow up again in some form or the other. So that remains. Geopolitics has become, geoeconomics, geopolitics has become a major risk. But that obviously doesn't, I mean, unlike what we saw in February this time, that is a evolving risk which goes over a period of time. So right now, my own focus would be on crude. That will drive emerging market and developed market inflation, which in turn will lead to a policy response. And that potentially is yet another macroeconomic risk that India might face going forward.
Absolutely. I think these are key things we should be focusing on as well. And crude becomes an important point in the entire gamut of things that's unveiling right now. But thank you, Saugata, so much for joining us on the show. It's always a pleasure to get your insights and your thoughts. Thank you. Stay safe and speak to you soon again.
Thank you, Hiral. Thank you so much for having me on your show.
Thanks.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.